This is part 2 in this series I started to teach you as a trader in any market how to master risk management. Now, in part 1, we talked about the balance between win rate and risk to reward and how to find what I like to call an equilibrium between both. And by using my risk management calculator, which you can see on my screen right now, taking into account our average loser and our average winner on a percentage basis and our win rate, we were able to gauge our expected return and our break-even risk to reward. If you didn't see part 1, I'll link it in the description below. Make sure to go watch that video and then come back so the rest of this video actually makes sense. And in today's video, we're going to be hopping back on inside my risk management calculator as I'm going to break down now another correlation between risk to reward and your break-even win rate. We're going to be using upside and downside to showcase break-even win rate. Now, what does break-even win rate even mean? Well, it essentially means that if you are trading a specific risk to reward based off of that break-even win rate presented, at that point, you will have to maintain at or above that percentage win rate in order to be profitable. So, for example, again, using downside and upside, not in percentage, in dollars, we're able to see that trading, say, a 3R or a 1 to 3, risking 200 to make 600, our break-even win rate is 25%, which means that we can lose 75% of our trades. But if we are sticking to trading that 1 to 3 risk to reward, we will be profitable as long as we're winning more than 25% of the time. If we're winning 25% of the time, we'll be break even. And if we are winning only 24% of the time, we are going to be losing money. It does not matter what the actual upside and downside is in dollars. Now, this example would be obviously trading a 1 to 3. So let's say we trade a 1 to 2 where our risk is 100 and our reward is 200. Now we can see our break-even win rate is 33.33%. Okay, we're risking one part to make 2. Or we're risking $100 to make $200. So as long as we maintain at or above a 33.33% win rate, we will be profitable. Now that should make sense. It's pretty straightforward, but let's say we reverse this and instead we're risking 200 to make 100. Okay, that would mean that our risk to reward ratio behind this trade, if this was an actual trade you were gonna take with a downside of 200 and an upside of 100, that 1 to 0.50 risk to reward, well, we would have a break-even win rate of 66.67%. So you can see now that we've actually flipped our multiple or our risk to reward, right? However you want to put it, well, we have to achieve twice as high of a win rate to break even. In the last video, we did talk about the correlation between win rate and risk to reward, knowing that the more you push your risk to reward, more than likely you will see a decrease in your win rate. And on the other hand, if you shoot for a more conservative risk to reward, for example, a 1 to 1, a 1 to 2 risk to reward, where you're risking one part to make 1 or one part to make 2, well, now you should see an increase in your win rate because your targets are getting hit more. To put this simply, let's just be aware that the more risk we put on the table in comparison to reward. So for example, if we're risking twice as much as we are even able to make on a trade, we're going to have to achieve a very high win rate. Okay. Now, on the other hand, if we start to push our risk to reward, so let's say we're trading a 1 to 5, right? Risking 100 to make 500. Well, you can see now our break-even win rate is only 16.67%. You understand the correlation between the risk to reward and the break-even win rate. What win rate do we have to achieve based off of the risk to reward that we're trading to break even? Makes sense. Now, what I want you to pay attention to, and in the next video, I'm really gonna hop into a lot more detail, but obviously we can see just trading a 1 to 3, where in this example, and it doesn't matter, it could be a 1 to 3 where our risk is 100 to make 300, or where our risk is 1,000 to make 3,000, we are still trading a 1 to 3 and our break-even win rate is still 25%. Putting yourself in a position mentally where you actually will be losing over 50% of the time, more than likely, is challenging. It's quite difficult, but it does not matter, because as long as you stick to consistently trading the same R multiple and you achieve a win rate of above your break even, you will be profitable. Now, the second you actually vary the position size, that all goes out the window. Because think about this. If you're taking one trade and that one trade is a 1 to 3 where your risk is 10 to make 30. But now let's say the next trade we take, our risk is 20 and our reward is 60. Well, we're still trading a 1 to 3, yet now we've actually doubled our risk. So if we just won the last trade and we made 30%, so now you could see, even if we won the last trade and we made that 30%, if we take another trade and now, even though, like I said, a 1 to 3 is a 1 to 3, but we've doubled what I like to call our risk exposure, well, we just gave back $20 of that 30 we just made. You see how it is vital that without a risk management calculator, you have to, in order to find consistency, virtually trade a consistent R multiple or risk to reward with a consistent position size. Now, to summarize, you can trade consistent R, but if the actual risk exposure, so the downside and the upside, are not equivalent, then you will be in a position to give back a lot of your gains. You are not going to be trading with consistent risk. So if you don't understand, just to recap, a $20 downside with a $60 upside is a 1 to 3, but so is a $10 downside with a $30 upside. And obviously our break-even win rate has remained consistent and our risk to reward has remained consistent. But if we are not accounting for that increase in risk exposure, if you're not accounting for doubling the actual risk behind the trade, even though you are trading the same R multiple or risk to reward, well, if that's not accounted for in position size, you're going to keep making money, giving it back, making money, giving it back. And that is the place that probably more than likely most of you are actually in. So we covered now the correlation between break-even win rate and risk to reward. Using downside and upside, know that these inputs, asset value, upside, and downside, are all going to be used when it comes time for us to actually take a trade. Because when you put on a position, when you take a trade, you should know exactly at which point you are going to be wrong, and if you're wrong, how much money you are going to lose. And at which point you are right, where you're going to take profit, how much money you are going to make. So we're going to take those two variables, the downside and the upside, in addition to the asset value. And those are three variables that we're going to need to determine at the end of the day what our position size for the trade is going to be. Now, as we progress, just know that the goal of the risk management calculator is to take your historical data as a trader, your historical performance, and the actual risk behind the trade that you're looking to take, and using both of those give you a position size. So it'll tell you how much money you should put on that position in order to manage risk consistently. Now, if you are interested in having access to the risk management calculator, it does come as part of my mentorship group. Now, my mentorship group includes a whole lot more than just the risk management calculator. If you'd like, at the end of the day, to learn how to trade, how to make money in the stock market, then click the first link in the description below. You can fill out the application and apply, and you'll learn more there. With that said, subscribe for more. Stay tuned for part 3. And with that said, I will see you all in the next video.